All right, chapter 12 is all about the exciting world of payroll accounting. So today we're going to quickly kind of go through an introduction and then look at section 12.1. Employers and employees all benefit from the protections provided by tax and labor laws, which cover a lot of what we'll talk about with payroll accounting. So most of you probably have a job, and you probably realize that money's taken out of your paycheck every week. So today we're going to focus more on calculating the gross earnings, which is more of the exciting stuff. That's the money you actually get before the deductions, which is the more depressing thing, which we'll look at on Friday and into next week. So when you look at gross earnings, that's the total amount of money that you would earn in a given pay period. Now, pay periods can be of different lengths, and we'll kind of talk about that more. But think about how often you're paid. That's generally a pay period. So some of you might be paid weekly. Sometimes you might be paid bi-weekly. Sometimes you're paid twice a month, every other week. That kind of thing. It just kind of depends on what your pay period is. The payroll deductions are the amounts that are going to be withheld from your gross earnings that are going to give you your net pay or your take-home pay when you subtract that from your earnings. Again, the deduction side will focus on Friday and into Monday. That's the less exciting side of payroll accounting. So if we look at payroll, what payroll is, a payroll, if you look at just the word itself, is a list of the employees and the payments due to each employee for the pay period. The collection and processing of all the information needed to prepare and issue the payroll checks is also commonly referred to as payroll. The generation of the payroll records needed for accounting purposes and for reporting to government agencies, management, and others, again, that's all that's all covered by payroll. Again, you have to obviously, as a business, account for how much you're paying people, various things that we'll get into. FICA, Social Security, those types of deductions, unemployment taxes, those are all things that government needs records of. So you, as a business, would need proper records of that. Most of the time, when you look at, again, how often people are paid, those pay periods, we have weekly, we have bi-weekly. Bi-weekly is every other week, which is different than semi-monthly, because semi-monthly means twice a month, which means you'd only be paid twice a month. Those pay periods then could be of different lengths. They wouldn't always be 2 weeks, because if you're every other week, there might be some months where you would actually be paid 3 times, not just the twice. And then the monthly. So for example, here at Mercy High School, we are paid monthly. We are paid every month. Again, in your own job, you might have a different pay period that you are paid over. A lot of businesses hire somebody specifically to handle the payroll. They might be known as the payroll clerk, or they might have some other job title. But their responsibilities are all very similar. They need to make sure the employees are paid on time, make sure each employee is paid the correct amount. Obviously, as a business, you don't want to make a mistake there. People would get antsy if you did not pay them what you should have paid them, especially if it's less. They probably wouldn't say much if you were paid more. But they're also in charge of the payroll records, submitting those reports to the various government agencies and to management, and then also paying the payroll taxes, which is important, something that businesses do have to pay. When you look at how pay can be determined, or how you can kind of compute gross earnings, there's different ways, and different industries generally do it a little bit differently. And a lot of your professional jobs, people work on salaries. A salary is just a fixed amount of money paid to each employee for each pay period. Really what that amounts to is, let's say your salary is $48,000 a year, for example. You would divide that by 12, and that would be your monthly paycheck, or divide it by, weeks if you're doing it weeks, and that would be your weekly check, or however you did it. You're just distributing that salary into each pay period equally. An hourly wage is an amount of money paid to an employee at a specific rate per hour. So I'm guessing most of you, if you have a job right now, you work as an hourly employee, which means um, you are paid, $9 an hour or $7.50 an hour, and you just find your wage by, or your pay by taking that wage times the number of hours worked. Not too hard. A lot of retail industry jobs are hourly, those types of things. Um, then you have your, why did we skip down to piece rate? Well, but we skipped down to piece rate here. You've got your piece rate pay, which sometimes can be seen in manufacturing businesses, where your pay based on the number of things you produce. Not something that you see a lot. And then you have commission, which is your basically a percentage of sales that you would make in addition to a wage sometimes, or sometimes not. Sometimes it's just straight commission. Sometimes it's a commission plus your salary or a bonus for reaching certain benchmarks. Some of you might have a time card that you actually punch to measure your hours worked for hourly employees. My guess is, though, that most of you do some sort of electronic badge reader, which, again, punch cards are really a thing of the past. It's probably an electronic badge reader, which looks a lot like a credit card, something like that you would swipe. Or maybe you simply write down the hours that you're working, and you're writing in and out the hours that you're there. Again, like I kind of went out of order here, I guess. This in sales, that's where you get a lot of your commission type jobs. Some sales employees make just commission, which means they only make money if they sell something. Or some sales employees are paid a salary plus commission, where they have a salary but it's relatively low. Most of their money then comes from a percentage of what they sold. If you look at the overtime rate, which was actually set by the Fair Labor Standards Act of 1938, it basically says that if you are a full-time employee and you work more than 40 hours per week, by law, they have to pay you overtime, which is 1.5 times your regular hourly rate. Now, there are some notable exceptions to overtime employees. Most people that have salaried positions are not eligible for overtime. They would be exempt from the law. For example, teachers here make more money than what the minimum is, so therefore they are exempt from the law. Teachers are not paid; they're salaried, and they're not paid overtime. But again, at your job, if you work more than 40 hours per week, you would then be eligible to get the overtime hours. So it's set at 40 hours per week. If you go about calculating pay, I'm going to have you look at 12.1 in your book, which is very, very simple. It's asking you to determine everybody's pay based on, for a pay period, based on their hourly rate and the hours that they worked. So you're simply going to work through that there, and I have these are the answers you should get. So if you worked 33.5 hours and your pay rate was $7.75 an hour, your regular earnings would be $259.63. You didn't earn any overtime, So your gross earnings would be $259.63. If you kind of go down to Jane Longus there, you can see that their pay rate was $7.25 an hour, and they worked 43 hours. Well, if you then look at that and say, well, how do I figure out what their regular earnings were? You would take the 40 hours times the 7.25, and that would give you the 290. You then take the additional 3 hours that they worked above 40 and apply the overtime rate to that. So if we know the overtime rate is 1.5, we would take 7.25 times 1.5, and that would give you $10.80. If we round, $10.88 an hour, and you would take that times the 3 hours you worked above, which would give you the 32, and if we round it again up, 32.63, which would then you add your regular earnings and your overtime earnings, and that would give you the 322.63. So if you were to do those calculations, you would see that the rest of those should work out. And I encourage you to do those and understand how we did those calculations, because later on you are going to have to fill out payroll records and that kind of thing and be able to calculate their earnings. Again, this is something that would be computerized today, but it's important to understand how they arrived at that so you can easily pick out mistakes, because sometimes mistakes are made and you can say, oh, that doesn't look right. Tomorrow we will look at the payroll deductions, which are the less exciting thing because it's money that's being withheld from your paycheck, and I don't like that, and I'm sure you guys don't like that. So we'll look at that, and we'll also look at withholding allowances, which is something that if you have a job now, you've filled out a W-2, or excuse me, a W-4, and you have to claim allowances and that kind of thing, and we'll kind of talk about what that means and so a practical application of it anyway.